Hi guys, Harry Yotis here, professional trader for 20 years now. Started my career in 2005 and still alive in 2026. So, as prophesied yesterday, today, Thursday, May 28th, the penultimate day of May, we're going to get a squeeze to month end. This is window dressing. This is exactly what we predicted, and we're probably going to get it. Okay, nothing seems to be stopping this market, no matter what. It looks like a runaway train. 2% maybe pullback was enough. And now we're just going to highs, unlimited upside. All right, let's talk about the squeeze to month end. Okay, but first of all, we're going to talk about the technical picture. Guys, we don't have to talk about it anymore. It's bullish. Okay, nothing has changed. However, we did mention yesterday that there is negative divergence, and that's starting. It's going to get weird. Okay, for the next 2 days, like we said, we're going to squeeze, but maybe next week, maybe starting after Monday, I suspect maybe on Tuesday going forward, there might be another pullback. Okay, just so we can get this negative divergence to play out, or the outside chance is a very small chance, is that we rip even higher and this goes and the negative divergence is nullified and it goes even higher on the charts, on the RSI and on the MACD. That remains to be seen. It could happen. We just don't know yet. Okay, so technically speaking, we're bullish. Sentiment always 60. Even though the market is up, we barely went up on the sentiment. Okay, that's because we are mixed everywhere. We have, of course, the momentum is at highs, but everything else is not that high. We are at fear on the strength and the breadth, as we mentioned before, and people still are buying calls. Okay, so it's basically the same story as yesterday. Okay, and this mixed reading is why we are still bullish. It's very good as a bull when you are mixed and uncertain. And I don't know, is this market going higher? It looks quote unquote looks parabolic. I don't want to go long, waiting for a pullback. Who knows? Okay, this is why we have to stay long. We're net long. You never get rid of that. And we have some short exposure and done it in an intelligent way so that you gain money while you're being short. Okay, so sentiment is in our favor, bullishness. And we also, on Thursday, we have the AAII Investor Sentiment Survey. And guess what? The bears are still there. 41.9% bearish, 35% bullish, below average on the bulls. This is what we're saying. The bears are still there. Okay, they're lingering. This is why it's perfect for the bullish case. Okay, we're not at extremes in any sense of the word. In terms of bullish extremes, we have mixed sentiment, we have mixed breadth, we have all of these things are very, very conducive to our bull case. Okay, if we go down, I'm hoping we go down. We're gonna go down one of these days, just don't know when. Okay, so it's basically the same thing. We're waiting for a squeeze to month end. We have this window dressing, if you will, and maybe it continues on Monday because the first couple of days of the month, investor flows come in, same as the last few days of the month. So we might continue this upward drift for a couple more days now. Okay, so Thursday we also had some macro data that's coming out, a slew of macro data. We'll go over it very quickly. We had the initial jobs claims. As always, we look at it. It's still very muted, still within 215,000 compared to 210,000 last week. Still nothing to worry about. This is very, very strong, bullish. Nothing is wrong. Okay. We also had PCE and core PCE. So what happened? What did we get? Core PCE 0.2%. Okay, compared to 0.3%. So it's actually lower than we had last month, which is good because it's telling you that the oil move is not really being reflected into the PCE, the personal consumption expenditure index. Okay, we're still back down to these 0.2 levels that we had all the way here in 2025. So in 2026, we're continuing this PCE of 0.2%. This is very, very good, very, very bullish, okay, because it means that we're not going to get rate hikes. And if you can see this picture of the Fedwatch tool that we always look at, this I'm looking at December, all year of 2026. Remember last time we looked at it, this was in the lead, this being the rate hike, okay, with wars coming in, oil ripping. Rate hike was at 40-something%, and it was the majority. But now, back down to nothing, no hike, 52%. Okay, so as the war continues and oil is going down, we're getting very, very bullish readings. Okay, no rate hikes, right? So that's very good for the inflation front. It's very good for the jobs front. And what's the last thing we look at? GDP. We had a GDP print here. It's very, very lagging. We had Q1 2026 GDP 1.6%. Okay, higher than last time, but low enough to make rate cuts still viable. Okay, they're expecting 2%. We got 1.6. So as long as the economy is hobbling along, not doing amazing, quote unquote. Okay, even though jobless claims are still not, people still have jobs. Okay, so this is not too hot. So it's not inflationary. So the inflationary narrative with these macro prints that we're seeing right here is taking a hit. Okay, basically the only thing that inflation is, the only reason why inflation is on the radar is because of oil. Okay, and today we had the big news. Oil prices turn lower as the U.S.-Iran ceasefire extension awaits Trump approval. So basically, they have a 60-day moratorium memorandum of understanding, an MOU, to extend the ceasefire for another 60 days. And then they will talk about the nuclear program during those 60 days. And Trump has yet to sign it, but this is very good news. So all of this macro news that came out, all these oil prices, U.S. oil went down. Okay, all of this is because inflation, see, today down, but meh. Because they don't know if they believe it or not. We've been fooled so many times with this whipsaw pattern. They don't know if they believe a ceasefire anymore. Okay, but basically, guys, look at the big picture. Okay, when it comes to oil, we've been hovering around the worst case scenario around $100 a barrel, with World War III almost starting and the Strait of Hormuz being closed. Something is happening. There's mitigating factors. You don't know what it is. Could be China has more supply than it pretends it has. Workarounds are being done and you have no idea. Maybe ships are shutting off their transponders. You have no idea, but oil is getting into the market. Okay, look, it just tells you that this entire down move forever since 2022 in oil was because we have so much of it, especially in the West. Okay, and imagine we have so much of it that a big war that closes Strait of Hormuz is not enough to take it to even $150 a barrel. Forget 200. Okay, we mentioned yesterday that we closed. I had a USO 190 USO short call that I covered. Okay, because people were freaking out and the premiums were super high. So you take advantage of that. You take advantage of the fear. This goes to show you how bad the oil market is in terms of going long. Okay, you really want to try to short this market, and we still have our shorts. Okay, so I'd like to end this segment because nothing has really changed. We're going to squeeze to month end. I still think we go higher. Okay, so I'd like to end this segment by going over some of the trades that we did. Yesterday we mentioned some, and today we have some updates. So a couple of updates in the service as a software as a service sector, SaaS. I like to call it SaaS. ServiceNow. Okay, we had a 85.80 put spread that we sold, and today because of the gap up, we covered it. Okay, we covered it. I was going to wait a couple more days, but guys, we realized basically 85% of the total profit we could possibly realize here. We covered it for pennies on the dollar. So really, when we bought it here, it took us, I don't know, a week and a half to cover it. Okay, and the reason we entered this trade, I want to say it again, we had negative divergence. The price was going down, and the RSI, everything was going up after a huge drop in the SaaS sector. It was done, and we were approaching this. We were approaching levels that were like support for long periods of time. So pull the trigger. It was about time. Okay, we had all this evidence to make a trade. So we covered our now for realizing 85% of the potential profit, and Shopify again after today's move, we're out of the 90 put again for about an 82.5, 83% of total premium that we collected here. That we sold, we collected. Okay, so instead of, we collected 82.5, let's say, cents for every dollar that we could possibly make on this trade. Okay, so why don't we update it? Get rid of it. We don't need it anymore. We got out of it. Okay, profitable trade. On to the next. Okay, and let's do that with now as well. Let's get rid of these guys. Okay, boom, done. Book it, forget it. Look to the next trade. Okay, and the next trade that I wanted to keep you guys up to date with is, of course, we still have Tesla. Okay, we still have this 465, 395 strangle going on, and we're going to hold it. As long as it's between this level, we're going to hold it. It expires next week. It expires in 3 weeks. We're going to hold it, see what happens. Okay, we have a little couple dots here. Let's get rid of it. So yeah, still going good. We've collected about, I can't remember how much, maybe $15 of credits so far on this. We'll see. If we can collect at least half of that, will be great. Okay. And of course, the bane of our existence is Intel. I like to mention Intel because look, Intel is down today or flat, while the semiconductor index is up. Okay, it was up like 0.1%. You have Micron, basically flat, whatever. So this is the better company. Micron is a better company. Intel is much worse. It doesn't make a lot of money. It actually barely makes money, whereas Micron makes like 40% plus net margin. Okay, these guys are flat. Okay, so this is why I still think this sector. Listen, guys, the SMH, okay, could go down while the market can go up or maybe down a bit. Okay, get down a lot. I mean, this thing could lose 10%, and it still be, go down from 6 to 540 here. That's the 10% drop. 660, 540. So right here would be a 10% drop, and the market won't go down that much if the breadth, like we mentioned here, the breadth comes back, which it could. The entire sector could be taking a breather while all the other stocks are being bid up. Okay, so don't get fooled by like this sector is, it's going to crash, therefore it's going to take the market down with it. No, these are just narratives. You don't know. The market is super strong. We said that before. Stay with it. The macro strong. Everything is strong. Okay, so we're still working this inverted triangle. I want to get short. I'm going to get short here on Intel. So this is the one that it's going to be a loser. I don't know how much of a loser it's going to be. Okay, just looking to get out of it. Okay, and go long, but not Intel. I'm looking to maybe go the SMH or MU. We'll see. I haven't decided yet. Okay, so that's it for our stocks. I'm also looking at another trade. I'm probably going to bring it up to you guys tomorrow to see the mechanics of it because it's going to be kind of long, and this video is already getting long. So let's reiterate. Squeeze to month end. We've said it before. A couple more days tomorrow, and maybe Monday it'll go up probably. Waiting to see if this negative divergence plays out after and the market goes down eventually. We might want to buy it. We will want to buy it. And we're going to see what we're going to buy when and if that happens. Okay. We saw the sentiment. It's still choppy. It's in greed. It can go much higher. It's not at extremes. And it's like mixed signals, which is great. This is what we want as bulls. And we just had the AAII. And of course, there's bears everywhere. I guess they're reading Twitter a lot. And they're thinking that everything crashes due to like a 1929 type of algo or something. I don't know. There's some kind of like, this chart looks like 2008 again. It's going to crash. Okay, no, not this time. Okay, so yes, we had all that sentiment is in our favor. As bulls, we had initial jobless claims, nothing muted. The macro number one in our favor. PCE price index, core, which strips energy and food, anemic. 0.2%. Very bullish for us. Good news. And GDP is 1.6. Not super hot, which means not 4.4%. Okay. Not super hot, which is great for the inflation case. All this is for the inflation case. And I think all of this data going forward, including the oil price and the oil price deal that Trump made, has gotten us to a Fedwatch tool whereby we're back in the no change column is in the majority. Okay, so all of this stuff, the inflation narrative is being slowly squeezed out of the market. It's going to be in the rear view mirror. Okay, and it's all because of oil. Okay, so we think this oil market might start to go down. We don't know yet. We need a concrete deal, like we said. This might be bid for a while, although if there are mitigating factors, you're going to see this squeeze low, even during the next 60 days. Okay, because there's going to be mitigating factors that we are unaware of. Okay, so that's it, guys. Let's see what happens towards the end of the month, tomorrow, Friday. Again, I suspect we squeeze higher, maybe just stay around these levels. Okay, nothing really great happening to derail this trade. All right, later, guys.